Look, if you're a real estate investor or business owner, you're going to love this. Trump's new tax bill is now passed, and one of the biggest wins, 100% bonus depreciation is back, and this time it's permanent. This is a game changer for anybody looking to maximize tax savings and build wealth faster. Tonight, I actually sat down with my personal CPAs, Brandon Hall and Thomas Castelli from Hall CPA. We broke down everything in a live webinar I actually hosted for my passive investor circle group. That's my private group of investors who either partner with me in RV park syndications or other real estate deals. In this session, we covered what this tax bill really means, how 100% bonus depreciation works, and how you can potentially use it to offset income, reduce taxes, and build wealth. If you're a high income earner or somebody looking to make work optional, you don't want to miss this. Stay tuned.
Percent bonus depreciation was introduced. Bonus depreciation was around before that. It was like 50%, but we don't have to talk about that today. 100% bonus depreciation was introduced in 2017 and was in place through 2022. And what that did has allowed business owners and real estate investors to 100% depreciate or fully depreciate certain assets within the first year of owning and operating that asset. In real estate specifically, you're going to have a few different types of depreciable lives. You're going to have 5-year property, which is tangible personal property. In the tax code world, it's called Section 1245. Then we're going to have land improvements. Those are depreciated over 15 years, and that's usually called 1250 property. And then you're going to have the actual building itself, which is going to be depreciated over 27 and a half years or 39 years in the case of commercial property. So with what bonus depreciation allows you to do specifically with real estate is completely expense or depreciate that 5 and 15-year property all within the first year that you acquire and place in service, which is basically when you list it for rent and it's rent ready, someone can move in. And that has been quite powerful because, to give you an example, let's just go through a quick example, might be the best way to explain it. Let's say you buy a $500,000 property. And let's just say that that $500,000 property, there's going to be a building, there's going to be improvements, they call that improvements, and then there's going to be the land. The land is not depreciated, but the land does have a value, and you can usually find that on the property tax card. But let's just assume, for the sake of argument here today, that it's $100,000 the land value. All right. And that means that your building is going to be $400,000 of that purchase price. Usually somewhere between 20 to 30% of that. We'll go right down the middle. We'll go right down to 25% for the sake of this example is going to be eligible for this 5, 7, and 15-year property that is eligible for 100% bonus depreciation. So if we take that $400,000, we're going to go right down the middle at 25%, and we're going to talk about a $100,000 deduction. Now, with 100% bonus depreciation, you're deducting that full $100,000 expense on top of your normal depreciation expense from the 27.5-year property or 39 years, all in the first year. And because this is a paper loss and only exists on paper, you are reducing your taxable income despite the fact that you may very well be putting positive cash flow in your pocket. So you're telling the IRS, hey, I lost some money, but you might actually be making money. And this loss is powerful because not only are you not paying taxes on your rental income, because that loss is going to wipe out whatever rental income you have in most cases, and you're going to have a sizable loss beyond that, that depending on your situation, you'll be able to use in different ways. For limited partners, this loss is typically going to be passive. What does that mean? That means that this loss can usually only offset other passive income, presumably from either other real estate you own directly, maybe you have a few rentals, or from other syndicates and funds that you may be invested in. That includes the rental income or distributions, whatever, however you want to look at it. The money that's the income really that's being thrown off from those K1s you have can be sheltered. The gains from the sale of syndicates can be sheltered using this loss, but that's usually how it's going to work if you're an LP. And I'm sure we could talk about how it works if you're active, if you qualify as a real estate professional or you short-term rentals, but that's how it works for an LP, and that's 100% bonus depreciation in a nutshell.
Yeah, if you
Yep.
guys have questions as they're talking, please drop them in the Q&A, and we'll make sure that we try to get to all of your questions as they come up at the end. Appreciate that.
Yeah, so in summary, 100% bonus depreciation is back. It is now permanent. It's here to stay. It's permanent until, they want to change the laws in the future, but there's no phasing out, nothing like that. So 100% bonus depreciation is here to stay. In summary, again, it applies to components with a useful life of less than 20 years. So you go get a cost seg study, you get the allocation, the 20 to 30% allocation that Tom was talking about. That allocation's to 5, 7, 15-year property, which qualifies for 100% bonus. So real estate investors are happy. Now, when you get the bonus depreciation, it's going to create a large tax loss. That tax loss to you is going to be passive by default. You have to jump through hoops, such as real estate professional status, the short term rental loophole, and others, in order to make that passive loss not passive. And if you can make it not passive or non passive, then it can offset your regular income, your business income, your W 2 income. Otherwise, the passive loss is suspended and it's carried forward. Now, something that I like to talk about here too is the concept of PIGs, passive income generators. And it doesn't have to be like anything fancy, but the idea is to think about, if I'm investing in LP deals and I'm getting large tax losses allocated back to me, that I can't use because those losses are passive. That's not a big deal. I know everybody's always trying to optimize every single dollar, which is totally fine. But at the end of the day, having large suspended losses isn't a big deal. It's definitely not optimized, but it's not terrible, because at some later point, when the LP deal sells, or when one of your LP deals sells, the gain on sale is considered passive activity income, which would then be used to tap into those suspended losses that you're carrying forward, which basically means that you can completely wipe out future gains on sale as long as you have these suspended losses sitting on your tax returns that you're carrying forward. Now, something that I like to try to work with our clients on, especially after they've built a portfolio and they're trying to figure out where to allocate their income, or their additional wealth, is to think about, how can you build a portfolio of passive activities that nets out against each other, right? So if you're investing in all this real estate and you've created this large suspended passive loss, and the real estate's continuously producing passive losses every year, how could you make investments that produce passive income for you, that are offset by the passive losses that you're generating, right? So you can actually have income coming in that you don't pay taxes on today, and that's a really great benefit of the passive losses. Now, how you do that is by identifying businesses that you can invest in. So, for example, if our CPA firm ever flipped to a C corporation and we ever offered shares, you could buy. Well, I guess C corporation wouldn't work.
You know,
work.
won't
No,
work.
never mind. Not C corporation. If you took a stake in our CPA firm, you gave us 100K and we allocated $10,000 back to you every single year. It's your share of the profits of the firm. That $10,000 would be passive to you, because, no offense, I'm not going to let you run the firm. I'm not going to let you participate in the firm. You're just giving us capital to go grow with, and we're going to allocate some profits back to you every single year. So the profits you receive are passive income. And that passive income can be offset by passive losses. There's actually a physician that did this and won in tax court. His name was Hardy. So it was Hardy versus Commissioner back in 2012. He had a real estate portfolio, and then he also invested in a surgical center that he used infrequently to do surgeries. But he wasn't part of the operations of the surgical center. He wasn't making management decisions. He wasn't doing anything related to the surgical center aside from purely investing in it. And the profits allocated back to him were passive, and he was using the rental losses to offset that passive income. IRS challenged it. Tax court agreed with Hardy. So anyway, it's a cool way to kind of net things out. But circling back to bonus depreciation, a couple caveats. One, this is only 100% bonus depreciation only applies for properties that are both acquired and placed into service after January 18th. I think it's January 19th and beyond. Might be after January 19th. So fact check me on that. But the point is that if you purchased a property before January 19th and put it into service after January 19th, you don't get 100% bonus depreciation. It has to be purchased and placed into service after January 18th or 19th. I'm just going to start using those dates interchangeably. Now, if you purchased a property and you placed it in service January 1st to January 18th, 19th, then you have 40% depreciation, bonus depreciation, because that's what the rules were at the time, right? If you purchased a property in 2024, you still have 60% bonus depreciation. So there's no retroactive treatment here. It starts on when does it actually? It
It's the
starts on
19th.
January 19th. January 19th. Yes, I've got it right here. Yeah.
Yeah, it was to coincide with the inauguration. That's really what it's for.
Got
That's
it.
why
Got
I
it.
think
Got
it's
it.
in
Got it.
there.
Okay. So
So
it starts on January 19th.
Brandon, there's a question from an anonymous attendee. In your example, where there was $100,000 in bonus depreciation, if you sell that property for $600,000 with a $100,000 profit, so what he was asking is the tax liability zero because of all of the
No.
depreciation that you'd gotten.
Okay. Let's answer this in two ways. I'll answer number one, and then Tom, I'll let you answer recapture. How's that sound?
Okay, that works.
All right. So the first thing to understand is that whenever you sell a passive activity, the gain on sale of a passive activity is considered passive activity income. Okay. And what that means is if I've got five rentals, and one of the rentals was my 500K example from Tom, right? So I got 100K bonus depreciation, and let's just say the 100K was also a tax loss. That's rental C. But then I go and I sell rental A for a $100,000 gain on sale. My 100K tax loss from rental C would offset my gain on sale from rental A. But now let's talk about depreciation recapture, Tom.
Yeah. So basically, what happens is when you buy a property, you're going to have your cost basis. Your cost basis is your purchase price plus some closing costs you're going to have at the time of sale, plus whatever improvements or capital improvements that you make to that property. In the example that I had before, we had a $500,000 property. Let's just consider that the cost basis for the sake of argument here. So what happens is when you take $100,000 of depreciation, that is going to reduce your cost basis by the amount of depreciation that you took. This is called accumulated depreciation because it will add up over the years that you own the property. But in this example, we'll keep it at 100. So what happens is your cost basis is now going to be $400,000. It's called your adjusted cost basis because you had your cost basis less depreciation, and now you have your cost basis in that property is going to be 400,000, right? So if you sold it for $600,000, you're actually going to have a capital gain of $200,000 in total. $100,000 of that is going to be considered depreciation recapture. The other $100,000 is going to be a capital gain from appreciation. So that is how that works. It's,
Yeah.
so your tax liability would not be zero because you would have used that presumably have used that other $100,000 loss already. If you didn't use it already, it will be unlocked and will help offset your gain, but you'd still have $100,000 gain though, because you still have the capital gain.
Yeah, so two important points to echo what Tom just said. If you had the 100K tax loss from the beginning and it was suspended on your tax returns, it is still available to offset future gains on sale. So if you sell this property that you purchased for 500K, if you sell it for 600, the key point to understand is that your adjusted basis decreases every time that you put a dollar of depreciation on it. So if I sell it for 600, the question would be, what is the adjusted basis? And the adjusted basis would be that 500K minus whatever the depreciation was. And so to keep things simple, we'll say 100K. My adjusted basis is 400. The gain, the sales price is 600. The total gain on sales 200. So if I had 100K suspended losses still on my books, then it would offset the 200K of total gain, leaving me with 100. But here's where people get really messed up, and here's what we've seen, especially with like the short-term rental loophole. If people bought in really saturated markets, like in the peak Airbnb fiasco or craziness a few years ago, what we've seen is people would buy for like, well, let's just use the same numbers, $500,000. They'd use the cost seg that cost seg study to create 100K of tax losses, thanks to depreciation. And that 100K of tax losses they use to offset their W-2 income because they materially participated in the short-term rental activities. And we're not going to dive into exactly how all that works. Just go with it. So now they're trying to sell their properties, and a lot of people are struggling to sell short-term rentals if they bought in saturated areas and if they bought a property that maybe wasn't differentiated enough. It's just too saturated from an inventory perspective in that specific geographic region. Now they're selling that same 500K property that they purchased. They might try to sell it for 480. All right. And so anybody listening, you might think, oh, okay, well, I bought it for 500. I'm selling it for 480. So I've got a $20,000 tax loss that I get to deduct, right? That's the go-to assumption that people make. But again, when you talk to your accountants, these annoying, pesky accountants, we go, hey, look, you bought it for 500, but you depreciated it 100K. And you used that tax loss, so you have no suspended tax loss. So your adjusted basis is 400,000 and you're selling it for 480. So that means you have an $80,000 gain thanks to depreciation recapture. So even though you actually have a real loss, you bought it for 500, you sold it for 480, tax wise, you have a gain because you already stripped that depreciation out and you used it to offset income in the past. So it is really important to understand just kind of how the depreciation recapture piece works. I mean, don't get me wrong, we love depreciation, and it's very rare that you see a situation where you should not use a cost segregation study. And when I say see a situation, you can literally model this out on an Excel spreadsheet. So you don't have to take my word for it. You don't have to take other people's words for it. But you can run a net present value calculation in Excel, and it will show you exactly what the net present value of making this cost segregation bonus depreciation decision is. And you can run through a few scenarios of, if I sell it for this, sell it for that on these timetables, how does that change the NPV? But that's how you model this out. So don't go on like accountants love to say, oh, everybody loves depreciation, but nobody ever talks about recapture, and everybody always has to pay it back, and it's not worth it. And that's accountants not understanding how NPV works. But yeah, we love depreciation, but it is very important to understand how the recapture piece works too.
Yeah. And you can mitigate all that too if you're in it for the long term. So
Yeah.
it's not as
Another
big of a deal as people will think.
another question: can you carry forward the bonus depreciation to future years? I'm not a qualified real estate professional, and I prefer not to do STR. I'm a high W-2 earner, and my wife is looking to become a qualified real estate pro in future years. When he says real estate pro, I take it he's talking about real estate professional status. But right now, he just want to know, can you carry forward the bonus depreciation to future years? Which that's just, yeah, if you don't use it, you can continue carrying it forward, correct?
Yes. So what happens is when you have the bonus depreciation, you're going to have a loss, right? That depreciation is being expensed on your P&L. It's going to create a tax loss. That tax loss by default is going to be passive. If you don't have any other passive income that year, and you're not a real estate professional or qualify for the special loss allowance or anything like that, then that loss is going to be suspended and carried forward to future years, where you can use it to offset other passive income in those future years or gains on the sale of other passive activities like a syndicate or fund or another rental property you own or a business that you might own, so on and so forth. Where the distinction here is that I think is worth pointing out, is that if and when your wife does qualify as a real estate professional, all the suspended passive losses that you had prior to her becoming a real estate professional remain suspended passive losses. Meaning, in the year that you become a real estate professional, those losses aren't just available for use. They're not non-passive at that point. They remain passive. Only the losses that are generated in the year that she qualifies as a real estate professional would be non-passive. So I think that's an important distinction to point out there because a lot of people are caught off guard when you tell them that. So,
And then to another continuation with bonus depreciation, Brian states bonus depreciation only kicks the tax can down the road if we are passive investors, correct?
I mean that's what depreciation is. The depreciation in it, regardless of whether you're passive or non-passive, kicks the tax can down the road, right? Because if I could claim the tax loss today, that I get the tax savings today, but at some point I've got that depreciation recapture on the back end that I'm gonna have to pay the piper, right? But what Tom said earlier, if you're willing to stay in real estate for the long haul, and what for the long haul means is effectively forever. If you're able to commit to building wealth through real estate and making that part of your portfolio, there's many ways to mitigate that, even as LP investors. It just kind of depends on the capital that you have to invest and the timing of the sales of the syndication investments as well. But yeah, and I saw somebody else ask, did you say gain on sale and capital gains are the same and considered passive income? And the answer is yes. I said gain on sale, but capital gain. There's capital gains, which is the up from the gain from appreciation, and then there's depreciation recapture, which is also a type of gain whenever you sell a property. But both of those gains, for the purposes of Section 469, which is the passive activity loss rules, both of those gains are considered passive income. And the significance of that is just that you can offset those gains with suspended losses.
If I sell my own rental property, can I invest the proceeds from the sale into a syndication using a 1031 exchange?
Long story short, no, not typically. So the way this works is when you have a 1031 exchange, you're only allowed, and this is thanks to the Tax Cuts and Jobs Act, for the most part. You can only 1031 exchange real property for real property. So that means that you must sell your real property and buy another piece of property. When you have a partnership or syndicate, a syndicate's a partnership. So you'd be selling your real property and trying to buy into a partnership interest, and that's a no-go. So that typically does not work. Now, there's two kind of workarounds for this. One of them is you can invest in a DST, a Delaware Statutory Trust, which is similar, not the same, but similar to a syndicate, where you have somebody else operate it. But the IRS has kind of blessed this as a vehicle for 1031 exchanges. So that's one way, a DST. The other way to do it, and this is expensive and costly from a compliance standpoint for the sponsors, which is why you won't normally see this unless the transactions are very large. And this is if you invested alongside the sponsor and their LPs as a tenant in common or as a tick. So this is what that would look like. Say you have sponsor, the sponsor buys 123 Main Street, right? You would be an owner on 123 Main Street, and then the LP entity, the investor entity, would be another owner. So you guys are both investing in the same property itself. But again, I don't want to go too much into the weeds here, but there's just a lot of compliance issues that you have to deal with from a tax and legal perspective, really to pull that off. And it's really only done on larger projects. So for practical purposes, no, you can't often do 1031 exchange into a syndicate.
We've had a few people do that. My business partner in Blue Metric Group, John Cascarano, he's a real estate attorney. So we've had some people sell their businesses or practices, and he's allowed them through a TIC, tenants in common, to come in alongside us in projects, exactly what you just said, to help mitigate their taxes. But typically, it is expensive. I think the minimum that he does is like $1 million, so it's got to be $1 million or more. Seven figures. Sometimes he'll consider 500,000, but it is real time consuming and expensive, and that's why it's set that much. So.
Well, the other option too is opportunity zone funds. They don't get a lot of credit. There were some tweaks to them in the bill, not super favorable, but that step up in basis, and you can roll any capital gain into opportunity zone funds too. So it's not just like, like doing a 1031, but essentially any gain from really any type of investment that you have, real estate, equities, stock market, bonds, etc., you can roll into opportunity zone funds, and there is I believe, a 5-year deferral. You get a step up or a reduction in the total amount that's ultimately going to be taxed whenever that capital gain should come due in 5 years. But now I think you have to hold the whole thing for like 30 years to get the actual return. Like the additional gain is not taxed after 30 years, which is way worse than what it was.
No. We just spoke to Nate about this today. Actually, we recorded a podcast on this. So you get the 10% step, you get the step up after 10 years, but you have to basically happens is in 30 years, that becomes your cost basis. So in other words, in 30 years is
Oh,
the
I see.
max. You can't just hold it forever. That's how it
Got it. Got
works.
it. Okay. Okay. So 30 years is a okay, cliff. Okay, that makes sense. Yeah, but that's just another way to do it, right? So the key here to understand is that, if you went to an accountant that is not like sitting in all of this real estate nuance all day long, and ask the same question, can I take my rental property and roll the gain into an LP investment? The response is going to be no, you cannot 1031 exchange a real property for a stake in a partnership. But we just went over a few different ways that you can still effectively get that done. And I should say there's one other option here is what we call the lazy man 1031 exchange.
Mhm.
You want to talk about that, Tom?
Yeah, the lazy 1031 exchange, everybody's favorite strategy that has nothing to do with the 1031 exchange. Okay, so the way this works is that with a 1031 exchange, let's back that up and just cover that real quick. Okay. So when you sell property and use a 1031 exchange, you have to use the entire sales proceeds to buy another property. You have 45 days from the date of sale to identify typically up to 3 properties. There's some exceptions there, but typically up to 3 properties. And then a total of 180 days from the date of sale, including those 45, to close on the property. At least one of those identified properties. Now that puts you in a little bit of a time crunch there, right? It also doesn't work for syndicates and funds unless you do one of these kind of workarounds we just discussed. So what you can do is you can buy another property in the same year you sell a property. And you could run a cost segregation study on this property, use bonus depreciation to generate a substantial loss from this property, like we talked about earlier. And then this loss would be used to offset the gain and depreciation recapture on the sale of the other property or the syndicate and fund, and effectively wipe out the gain. And they call it a lazy 1031 exchange because you're effectively getting the same effect of a 1031 exchange, more or less, without having to go through those time hurdles of 45 and 180 days. And one more thing I would say on that though, is that the 1031 exchange you can do cross year. What I mean by that is you can sell property in November and close on the new property in January of the following year and still defer your taxes. With the lazy 1031 exchange, it has to be in the same calendar year. So you have to buy the property and sell the property in whichever order, but it has to be within the same calendar year. So something.
Here's a good question. So like if you invest as an LP in a syndication, say this year, 2025, you get the 100% bonus depreciation. How much depreciation do they get in the next years? Like if it's a 5-year hold, years 2, 3, 4, and 5, how does that work?
Yeah. So long story short, what's going to happen is that when you what's going to happen is when you do the cost segregation study, you're going to have the rest of that 27 and a half or 39-year property, depending if it's commercial or residential, that is going to continue to depreciate each year. So you're going to have depreciated that 5, 7, and 15-year property, all that property with 20 years or less, but you're going to get the remaining amount. And I'm going to ballpark this number for you. Hopefully no accountants on here are going to kill me for ballparking this, but we'll go back to the situation we had before, right? You had okay, so you had $500,000 property, 100,000 allocated to land, which is not depreciated. You took $100,000 in bonus depreciation. That would leave you with the remaining cost basis or adjusted cost basis of $300,000. This is assuming the rest that's allocated to 27 and a half year. You get roughly $10,900 per year in this example, roughly. The actual depreciation calculations would be a little bit different, but that's roughly what you get on an annual basis, more or less.
Got it. Let's see. We have another question. If I use a paper loss from a syndication to offset passive rental income, what will happen with depreciation recapture when the property sells?
Yeah, you would just have to pay. You'd have to pay tax on the depreciation recapture unless you use a strategy to mitigate it, because you've used all your. In this, it sounds like you've used this passive losses already, so they've already been used up. So what's basically going to happen is you're just going to have a gain, presumably from appreciation, and then a gain from the depreciation recapture, which again, you could use lazy 1031 exchange to offset that. You could defer it in certain ways, maybe to a qualified opportunity fund, at least the capital gain portion of it. But yeah, there's ways to mitigate that.
Got it. Anything else besides the 100% bonus depreciation that's in the bill, quote, real estate related, we could discuss or that's worthy discussing?
Um, I think Brandon covered the qualified opportunity zones before. That was pretty big for real estate investors. Um, Other thing for real estate investors going to be the QBI deduction that applies to business owners too. So I know a lot of people in here have dental practices you mentioned. They basically extended that again. So 20% on your business income. They wanted to get it to 23%, but they only got it in for 20.
Hmm.
And if you have rental properties, you can sometimes qualify for that deduction too. There's also Section 179, which is good for commercial properties. It allows you to expense certain components like HVAC systems and things like that would otherwise be considered, 39-year property. That's for commercial properties. I'm trying to think if there's anything else that's pretty major. I mean, there's some other things, interest limitations. That's mainly for syndicates and funds. There's a limitation on the amount of interest you can deduct unless you elected into the ADS system, which limited the amount of depreciation. But they changed some of those rules. A long story short, made it more favorable for syndicators. Um, Trying to
The
think.
last one that I would say that is most likely going to impact many taxpayers, whether or not you invest in real estate, is the SALT cap limits increasing to $40,000. So the state and local income tax deduction prior to really between 2017 and now was limited to $10,000. So prior to 2017, if you were preparing your tax return back then, you were probably itemizing your deductions because on Schedule A, where you itemize deductions, you deduct mortgage interest, you get to deduct all of your property taxes, and then you get to also deduct the state and local income taxes that you are paying, right? And so if you're a physician, if you're a dentist, if you're a high income earner, you're probably paying a lot in state and local income taxes on top of your federal tax bill. So Schedule A allowed you to fully deduct all of that. But in 2017, they put a limit of $10,000 on that state and local income tax deduction. And so all these people that were itemizing, like the vast majority, when I say the vast majority, I think I saw a stat on it one time. It was like 90 something percent. So like most taxpayers shifted from itemizing using Schedule A to just taking the standard deduction every single year. And the standard deduction had increased. But anyway, the point is just that now that $10,000 cap has been increased to $40,000. So people are going, that's a big win for higher income earners that could now deduct a full $40,000 of state and local income taxes, whereas previously they were probably just taking the standard deduction.
Which would, I guess, help if you're in a high, like a California or New Jersey
Oh
or
yeah.
something like that.
Oh yeah, definitely. Definitely.
Okay. Another question. Let's see. What percentage of passive rental income can you write off in a single year, assuming the paper loss is greater than your rental income? My understanding was it was not 100%.
It depends if you
Yeah, go ahead. Go ahead.
I would say it depends. It depends on a few different things. If you qualify for the special loss allowance, which allows you to deduct up to $25,000 in rental losses, that's the cap. If you make under $100,000 in modified adjusted gross income, I'm gonna assume that many people on this call today make more than that, and you're not going to be
Yeah.
eligible for that. Um, so that means it would typically be passive. However, if it's a short-term rental or you qualify for the real estate professional status, you can deduct losses, but there's a cap. It's called the excess business loss limitations, EBL, they call it for short, and that limits the amount of business losses you can take against non-business income. And this usually impacts high W-2 income earners or perhaps people with large amounts of portfolio income or both, right? And this amount says that the max in 2025 you can deduct is $313,000 if you're single, or double that for $626,000 if you're married filing joint. So to give a quick example, let's say you had a $700,000 in losses, right, from your rental property. You bought a big, gigantic multifamily property, or perhaps a mobile home park, whatever it might be. And you qualify for as a real estate professional, and you made $1 million in income, or your spouse made $1 million in income. Well, you can't deduct the full $700,000 against that $1 million of W-2 income because of the excess business loss limitations. You can only deduct a max of $626,000. The remaining, whatever that is there, it's like 76,000, whatever it is, will be suspended and carried forward to the future years as a net operating loss, which has different rules. Now, this was interesting because what the Senate, I think it was the Senate or the House, what they wanted to originally do is make this excess business loss, this EBL, in the following year continue to be an EBL. Or an excess business loss. So that means if you had another bunch of losses, they would kind of just stack up, and you would eventually just have stuck with all these excess business losses that you can't use. But what they did is they kept it as a net operating loss, which has different rules, which was originally thought to be a loophole back in 2017, because it's like, why would you do that? But basically, with a net operating loss, you can deduct you can use it to deduct up to 80% of your income. So you have just more favorable rules the following year, is what I'm just trying to say, if that all makes sense.
I have a SALT tax question follow-up. Does SALT impact state real estate taxes, or strictly state income taxes?
I don't know that.
Well, you can deduct your property taxes for your like primary residence, but state and local income taxes is really what it's going after. State and local taxes, I think. Yeah, it's like income tax. So property taxes would be separate, I believe, or is that included?
I'm pretty sure that's all included under that
Oh, it's all
SALT cap
included. Okay.
limitation. But it's not going to impact your property taxes. That is, like, it doesn't change your property taxes. They're still going to be your property taxes. Just changes the amount
Yeah.
you might be able to deduct.
Yeah, and to be clear too, if you have rental property that you're already like running as a rental, the property taxes there will just be deducted on Schedule E with that rental property. So we see that mistake every once in a while where people try to like deduct the property taxes from their rental property on Schedule A, and it's backwards and doesn't quite work.
Yeah, and one more thing for the SALT cap too is there's an income threshold for this too. If you make over $500,000, it phases out to the point where if you're making $600,000, it goes back down to $10,000 is that cap. So high income earners get the short end of that stick right there.
You'd mentioned this somebody that was a physician and their spouse was making $1 million. If you find out any more about those spouses, let me know, because I could potentially.
I could use one of those too, man.
Just kidding. Just kidding. We'll make sure we edit that out for my wife. Tell me a little bit if y'all have any other real estate or questions, keep dropping them in. But I'm kind of curious about the tax credit, and then I think it was a one-time $1,000 tax, not a tax, but actual $1,000 credit that they were going to give us for a child tax account or something if we open one up, if the child was born, I guess, between 2025 and whatever. Tell me a little bit about that.
Oh, the MAGA accounts.
MAGA accounts, yeah.
The baby MAGA account or something like that.
Yeah. Go ahead, Tom.
Yeah, so this is my understanding of it. I haven't kept up to date, but perhaps I should. Is the basically what happens is when if your child's born between 2025, I believe it's 2028, the government will open up an account. You have to open it up, I think, but they'll fund it with $1,000, and that you can contribute up to $5,000 per year of your own money to this account, and it will grow tax free until they're, I believe, 18, where it can be used for education, buying their first house, certain types of business opportunities. I'm not 100% sure on that one. And then uh, basically, I think it's taxes capital gains. So that is the MAGA provisions as I understand it, which is pretty good
Yeah,
if you're going
just
to have a kid.
a couple points of clarification. Your child has to be born in 2025 or later. So 2024 children do not qualify for this.
Bummer.
You will handle all of this when you file taxes in 2026. So, like a year from now. And the way that you actually handle this is so you have to set up the account. You also have to fund the account. And then when you prepare your tax returns, you claim a $1,000 credit. So you get it back when you file your tax returns. It's very similar to like a Roth IRA or just a regular IRA. Like you fund it, right? And then you report it on your taxes. That's what's going on here. And it is just a one-time $1,000 tax credit. You cannot claim it every year. You can contribute up to $5,000, but you cannot get $5,000 of tax credits. You can only get $1,000 of tax credits. And I want to say, is there an AGI limit on this? I can't remember.
I don't know.
It's not in my summary, so maybe not. Let me see real quick because some when I say AGI limit, some of this yeah, it doesn't look like there's an AGI limit. So some of these credits that are available, you get phased out of the more income you earn, but I think this one I don't believe there's a phase out. So it's really like depending on how you voted, you may or may not like this, but it's from a pure objective financial perspective, it's great. And if you have children born 2025 or later, you should totally do it.
I guess that would include grandkids too. If the grandparent, could they open it for the grandchild? I guess.
So there is a definition of eligible children, and I'm not 100% sure on that question. That's a great question though. Do you know, Tom?
I don't know. We could look it up though. We could find out.
Yeah.
Eligible child. Yeah, usually this eligible child is one born if their U.S. citizenship birth date must be between 2028. Um, uh, does not say it
Typically
has to
there
be.
are exclusions, so I don't know.
Let's see.
But I don't know off the top of my
I
head.
wouldn't be surprised if it's gonna have to. You have to be like their legal guardian, a parent or legal guardian. So,
Okay.
um, which for a child younger than 8. So, which I don't. Yeah, it does not make. Okay, that does not make sense. But the math is the same math in there. But it looks like it has to be your child or you have to be their legal guardian.
Got it. Let's see, you have another question. What are the pros and cons of investing in a syndication with an LLC versus a personal account? That's the first question to a two-part question.
Yeah. So from a tax perspective, there really is no benefit for the most part. It's mainly for asset protection. And usually, and I'm not an attorney, so don't quote me on this, it's to protect, it's basically, it would be at that point to protect your creditors from perhaps taking interest in that investment because as an LP, you're inherently not liable for what happens within that actual real estate partnership itself. So you're more or less protecting your assets from other people, basically.
Right. Yeah, because we've had, in the multiple different syndications that I've been a part of, I mean, we've had somebody get shot in an apartment before. We've had fires, we've had floods, we've had hurricanes. And that's when we start getting the flood of questions. Am I liable? Am I liable? No, as an LP, you're not liable for anything. We have casualty insurance or property insurance or whatever that handles it. So it's nothing to do with that. So that wouldn't, whether you invest as Joe Smith, your name, or Joe Smith LLC doesn't make a difference. That's what you're saying.
Yeah.
Okay. The other second part to this question, he talks about the syndication offering that I just posted, where those are multiple. It's a fund, so there's multiple RV parks in there. We just acquired it. Our largest yet, over $100 million project. The guy was like 77 years old, and he had a couple of people that offered him more money than we did, but this
Mm.
is literally his baby. And where all these, and we went around and looked at, I mean, these are really, really nice properties on a lot of them are on the East Coast, North Carolina, your neck of the woods. And he just didn't want to just to hand it over to anybody. He wanted to make sure that somebody was going to not only take care of his employees, right, manage it right, that sort of thing. So we were able to, it took about 7 months, we were able to get it. Because it's in different multiple states. He was saying that this is going to generate multiple K1s. What is the typical CPA cost for handling them? Is the handling fee substantial to offset the K1 income? Well, the syndicators, we're going to provide, you guys do our K1s. So we're going to provide the LPs the K1s for anybody that invests in it. Because okay, maybe you can kind of walk them through that process. So I'm an LP. I invest in this project. Next year, when I get my K1 that'll be sent from us to them, how does that work?
Yeah, well, I guess it's a great question. And the first expectation that I would have as an LP is when I invest into a syndication or a fund, real estate or otherwise, I've now entered a completely different ball game in terms of sophistication level and how that impacts tax compliance. So what I mean, the baseline expectation that you should have is when you enter that ball game, when it's going it's from the minors to the major leagues. Expect to extend and expect to file your returns on October 15th. So learn what that world looks like. And if you go in with that expectation, you'll be very happy with your LP investments because sometimes some of these syndications and funds can get everything done in March and April. A lot of them get it all done during the summer times and during the summertime. So just be aware of that. But when you invest in a syndication as an LP, you're passive. You're 100% passive. Like you can join the investor calls and stuff, but like you're passive. You're a limited partner, so kind of going back to that whole liability piece, like you're limited in the risk in the loss that you can claim or take if something goes wrong. But from a tax perspective, that passive piece just means you just sit around and wait for a K1 to come out. And what happens on our end is we're going to prepare a Form 1065 for the partnership. That's a partnership tax return for the syndication of the fund. And as part of that preparation process, we generate the K1s for all of the investors, all of the partners in the partnership, the GPs, the LPs, and then we now have technology where we can just press a button and it goes bam out to all of your emails so that you can download them and then send them to your own accountant. So you don't have to prepare K1, you don't have to do anything. Now your accountant will probably, if they're good, will probably charge you to now deal with that K1 because that is a reporting document that they now have to collect. They have to put it into your tax returns. It does take time and effort and energy to do that. So expect an additional fee, maybe $100, $200. It's not a ton of money. Now, where it can get tricky, and this is what I've seen with LPs, where it can get tricky is if you are the person that creates the state nexus issues, or you're just investing in a syndication that has a lot of state nexus compliance. Now, what I mean by that is if I live in New York City or New York, just the whole state, and I invest in a Texas syndication, the way that the nexus laws work is that the syndication probably now has to file a New York State tax return, which means all the partners potentially have to file a New York State tax return, or at least some of the partners now have to file a New York State tax return, even though they don't live in New York. So what can happen as an LP is if you are placing investments in a lot of different states and a lot of different syndications, you could be subject to a lot of state compliance issues or just new state laws that you have to comply with. That's where we see it get really expensive because every additional state that we have to deal with is going to be like $500 to $1,000 per state. That's just it's an extra state tax return that now we have to go and prepare top to bottom. So that K1 could get pretty expensive from that perspective. So just be thoughtful of where you're investing and what state compliance rules that might trip. But if you're talking to a CPA, if you're talking to a local CPA, they might not know. If you talk to a firm like ours, we work in every single state, so we know all the state compliance rules. So we're able to help our clients that are investing in LP deals understand that impact before they pull the trigger.
Yeah. And or you just have a bunch of state K1s, and that's just something you have to monitor. I know I have so many K1s in so many states that I have to file, and because of LP investments, this is part of the game. It's part of the game.
Yep. Excellent. Any other questions or any other highlights that we need to address from the bill before we call it a night?
Charitable deductions. If you're a highly charitable person, just know that that is now capped at 35% of earnings for high income earners, where it used to be 100%. So that's something to keep in mind if you're somebody that gives a lot. You might want to double check if you're going to be limited there. But I think the big one's 100% bonus depreciation being made permanent, and a lot of the other stuff we've already kind of talked about.
Mm-hmm.
Yeah, I mean the big one's 100% bonus depreciation for sure.
Yeah.
Gotcha.
Yeah, and that's huge. That's huge. And expect a lot more investment in real estate because of that. And that's kind of what that's incentivized to do. So it will do as it's intended.
Yeah, so if you guys want a free discovery meeting, and this is how I started with Tom and Brandon, I put a link there. You can schedule the call. They'll ask you a few questions. They'll go over some things. They'll look over your stuff, and they looked over my stuff, and I was sort of the quote guinea pig because at the time they weren't really doing many dental offices, doing mostly real estate. But now that they've completely taken over my dental practice, the reporting that I've gotten is just like night and day. I mean, it's wonderful. They go through. I get PDFs. I never got anything like that before. Do a great job with that. Plus, top notch with real estate. The So I put the link there. Hopefully they'll have enough pennies to put together and get Thomas a stand for his microphone so he doesn't have to hold it. So we'd really appreciate that.
Yeah, no. Yeah, no, I left my mic stand in my closet back at home. But it's I'm
I'm
holding
trying
it
to
like
get
a chin's ear.
I'm trying to get Tom to like fill his office background out. He's got
Yeah.
like, did you ever hang that picture? Is it still laying up against
It's
your
still
wall?
laying up against the wall. So I'm not at home right now. I'm at my parents' house for a wedding. But
That's
yeah.
Looks like we had another question come in. Actually, it's a pretty good question. If we can deduct $100,000 out of the $500,000 in your example, why do we call it 100% depreciation in the first year?
That's a good question because you're able to depreciate 100% of certain components, right? Not so it's 100% depreciation of components with a 20-year class life or less. When you buy a rental property, it's typically depreciated over 27 and a half or 39 years, which are over that amount. So they're not eligible for 100% bonus depreciation, but certain components within that property are. So the cost segregation study does is give you basically a report that says, here's all the components of your property, here's their depreciable lives, and the ones that are eligible for 100% bonus are 20 years less. So that's a 5, 7, 15-year property. So it is 100% bonus depreciation on those specific components.
I did a cost segregation study. We bought a mobile home park in my area last month, did the cost seg study last week, and I drove through. They had me drive through with my phone and record, I need to see the mailboxes, I need to see the roads, this and that. And then they'll send us a report. I remember you guys doing a webinar for us last year, And do you remember what you said about if you look at the different asset classes, apartment, self-storage, short-term rentals, RV parks, mobile home parks? Do you remember what you said about the amount of year one depreciation you can get of the purchase price in that first year? Can you maybe go over that real quick before we depart again? Do you remember that, Brandon?
Yeah.
Okay.
Do you know him, Tom?
I don't remember the specifics, but it has to be
Okay.
mobile home parks have to be the first one because of all the land improvements. And then you got
Yeah,
to, yeah.
yeah, I think I was trying to like give you a general percentage range of
General,
like the
yeah.
different types of assets. So typically like a single family rental, a short-term rental, it's like 15 to 20% of the purchase price ultimately gets allocated to 5, 7, and 15-year property. So now with 100% bonus depreciation, $1 million, short-term rental log cabin beach home, will probably end up with 150K to 200K of bonus depreciation that's deducted in year one. A multifamily property is typically like 20 to 30%. When you start getting into like the industrial property, the car washes, that type of stuff, you start to see like 50 and 50 plus percent because a lot of it's land improvements. Car washes, we've seen you get up to like 90%. Mobile home parks typically about 70% because what's going on is, and when I'm saying the percentages, I'm talking percentage of purchase price that ultimately gets allocated to 5, 7, 15-year property. But if you think about a mobile home park, like what does a mobile home park have that a single family rental does not? Well, a mobile home park has concrete pads, and those concrete pads are considered land improvements. And that is the majority of the value of a mobile home park. So
RV parks too, concrete pads,
yeah, same
correct.
thing. So
Mhm.
so 70% of the purchase price can be allocated to these pads that in the pads are considered 15-year property, but bonus depreciation applies to any property with a useful life of less than 20 years. So if 70% of the asset value is the concrete pads, and that's 15-year property, then 70% of the purchase price can be written off in the first year. So $1 million mobile home park, you get a $700,000 bonus depreciation deduction. So it just juices the tax benefits. The type of like each asset class has different ratios based
Mhm.
on what the makeup of that asset class is. And if you need another example to really make this concrete, what's the difference between a 4-unit property and a single family home? Well, the 4-unit property has more appliances, it has more carpeting, it has more plumbing and electrical that feed the appliances. All of that is considered personal property. So that's why multifamily, they have 4 instances of everything that a single family home has in a 4-unit property. So a 4-unit property is going to see like a 24 to 25% allocation, whereas the same single family home or comparative single family home might only see 16 to 18% of an allocation.
Well, that fourplex in Louisiana probably just going to have one of everything. We just use everybody's washer and dryer or whatever. We just share.
I don't know. I don't know about that, man. I'm gonna stay
That
up here
that's
in
a but
Raleigh.
that's a big difference between, if you get in like an apartment syndication and you get into an RV park or a mobile home park syndication, that's a big difference, right? In year one depreciation.
Huge, huge
Yeah.
difference. Yep. And if you're an LP, looking at syndications, it's really important to understand the tax allocations and how those work. It's always in the operating agreement, like how depreciation is being allocated between LPs and GPs. Just important to get some eyes on it as an LP. If you don't know how to read that section, again, recommend that you touch base with a CPA
Hmm.
that can read that for you and help translate it into something that you can make a decision based on.
Excellent. And then looks like the last question, and 100% bonus depreciation can be carried over the years if it's not used within the same year as the cost seg study.
Yes.
That is correct.
Yep.
Yeah.
Suspended passive losses. That's what it translates into. Because bonus depreciation is an expense that creates a loss, right? So I've got 100K revenue, 200K bonus depreciation. Revenue 100K minus 200K equals negative 100K.
And what
So
happens
that
if you
negative
pass away?
100K That negative 100K is a tax loss. It's passive. It gets suspended, carried forward if you don't have passive income. Sorry, what did you say, Jeff?
If you pass away and that goes to your heirs, what happens to that
The
scenario?
loss is used on your estate return, your state tax return, your final
Okay,
return.
gotcha.
Yeah.
Perfect.
But then your heirs receive the assets at the fair market value, and it's all wiped out. So it's best
Yeah,
to
stepped
die
up
with your real
basis.
estate.
Yeah.
That's the exit plan.
Okay. I'll get my wife to take me out whenever, we're got plenty of depreciation. So, thank you guys so much. I want to be respectful of everybody's time. We're about roughly about an hour. I did start this recording just a little bit late, but I think we were getting into the meat of it. So I will get this out to everybody. We'll probably get a transcript. I'll let AI do that for me as well. I appreciate you guys' time. Again, you've got the link there if you guys want to sign up for the discovery call with Hall CPA. If you want to find out more about the Project Echo offering, you've got it there. Again, thank you guys, and till next time, take care.
Thanks. Thanks, Jeff. Thanks,
Have a
everyone.
good one.